steps to defending an options trade, primarily looking at futures options today, but it does apply to any underlying market that you're looking at. And I want to look, Mikey, primarily at defending a short options trade, because long options, sorry to say, not a lot of defense. If you think a market's going higher and you buy a call option and the market doesn't go higher, then it just loses its value and you can choose to buy another call option in the next expiration or not. Short options, a lot of defensive mechanics for them. And I want to speak to the most popular, or one of the most popular short option strategies, the straddle. Maybe you can help us define what the straddle is technically and what an example like this looks like as well, because it's a short straddle strategy, but it's got two parts, right? And what do I want to necessarily get done with these two parts?
Sure. So a short straddle is just an at the money strangle. And I'm not going to define a strategy with another strategy. So breaking it down another layer, a short straddle is selling an at the money call option and selling an at the money put option. Now, the reason you'd look to a straddle as opposed to a strangle is that you're going to get paid a lot more on those short options by having them closer to the money. So in this example here, the underlying is $100. You're selling the 100 call and the 100 put. You're bringing in $5 in credit, which means you have $5 of break-even room, both to the upside and the downside. So your outlook on the stock here would be you want it to stay within that 95 and 105 strike, and you just try to manage it or close it. I think we look around 25%, maybe 30 or 50% buy that straddle back if the underlying has stayed within those two strikes there.
Yeah, and management for, like 10%, 20%, whatever of the credit, that's up to you. And that's a different story here. I do want to focus in on just when things go wrong with a strategy like this, because we did, I sold a straddle in our SFX options and that went wrong. And I want to show people, what I did and what I tend to do. But yeah, you sell the at the money call, you sell the at the money put. I got myself $5. If the market just stays at 100 between now and expiration, I make $5. If it moves up a little bit or down a little bit, I can still make, $2, $3, $4, depending on how far it moves. If it moves higher than 105 or lower than 95, I'm in some trouble. Now I'm starting to be out some money. Those are my break evens. So let's take this example further. The market moves outside my profit zone. Then I'm theoretically long or short that underlying market. In this example, I sold the 100 straddle. The market moved above 105. I'm short now. I'm short this market I still have, a put option that's probably worthless and a call option that has now become worth a good amount of money and is now acting like a short position in the underlying market. And Mikey, when you're dealing with especially futures options and the margins are so efficient, if I've got an in the money short call and it's acting like a short futures contract, I might as well just convert that futures contract, the futures options contract, to the futures themselves, because my, for the SFX example that I had going, I sold a straddle with a buying power of like $200. And that in the money short call still has a margin of about $200 or so. The short futures contract has a margin of about $200, and I don't have to deal with an in the money option that could be exercised, though it's very unlikely. I can just deal with the short future. It's a lot simpler, and the market is just above the price that I shorted it at.
Whoa, that's super interesting. I had never thought about it this way, because coming from the stock world, if you're short the out of the money call, well, that becomes in the money. You're going to need to put up a lot of capital to buy that underlying stock position, especially you're trading something like Amazon or Apple. There's $100 there. You're getting 100 shares. Can very easily get expensive. So in this situation, are you also managing that short put now that's out of the money and pretty much worthless? So you'd close the short put, convert your short call into a short futures position, and then maybe add something on top of there to reduce your cost basis? Or what's the next step?
Exactly right. My first step is going to be pretty much at the same time. I'm going to, and it doesn't have to be the same exact second. It's really, unless you're dealing with a very volatile, very big market, it's not going to be that crazy. I'm going to buy back the straddle, and then I'm going to sell the futures contract And so then I am, in theory, short from my upside break even from my initial strategy. And so I'm short from 105. Let's say the market's at 107. I'm going to sell an at the money put against where my short was. So I want to sell the 105 put against it to bring in some more premium in case the market stays around here or stays a little bit above my short price. Now you want to make sure I'm not selling a put above 105, because if you sell an option, Mikey, above that break even there, then you're going to have a problem in that you'll lock in a loss. I don't want to get into all the math of that, but just make sure I'm short from 105. I sell the 105 put, the market's up at 107 or whatever. And now when it reverts back below 105, I have moved back to profits and hopefully, a decent amount of profits, especially if I've been rolling out that short put and bringing in more and more credit. And that's how you defend that options trade, just biding your time for the market to normalize back to a more a recent level that it's traded around.
This is super cool. We talked about buying options in the beginning. It's like playing checkers. Doing options, selling options, like playing chess. Selling options on futures is like blitz chess. This is so cool. So you're actually maintaining very similar directional exposure as well, because the deltas work in your favor here. Your short futures position is going to be about 50 short deltas. Your short put's going to be a little less than that. So you're still net short. Really awesome. Great analysis. Appreciate this deeply.
Very cool, my friend. I appreciate you jumping on with me here on Friday afternoon to talk defending options trades. That works for everything, but futures options being so efficient with that margining, it really simplifies that process a lot there. And yeah, you don't have to be short shares, or long shares are even expensive. But that's enough of us, Mikey. Everybody, thanks so much for watching Small Stakes as always and supporting the small exchange. We'll be back for more next week, but Splashing of Futures is coming up next. And I think it's a rare solo Anton set. You're going to want to catch that, everybody. So stick around. Have a great and safe weekend. Peace.